Thanks everybody for being here today. As always, we are excited to share the latest housing market data with you. This webinar is being recorded. I will send out an email with both the recording and the slides in the next day or so. It will also be available on our website. And if you have any questions throughout today's presentation, please feel free to send them over in the Q&A, and we will get as many of those answered as possible. And with that, I'll hand it over to you, David.
Thank you, Anne. Anne is our rock star. She's always on it with this stuff, and she puts me to shame in how to work the Zoom stuff because I'm an old dinosaur. Okay, let's get our screen shared here. Speaking of old dinosaurs, how's that for a transition, huh? That's pretty good, if you ask me. So people say if you want people to pay attention when you're speaking, you have to surprise them with a shocking fact. So here it is. Think about this. Our water is so old that statistically speaking, every time you drink a glass of fresh water, you're very likely swallowing a water molecule that passed through the body of a dinosaur, passed through the kidney, the liver of a dinosaur, whatever, passed through the body of a dinosaur from millions of years ago. Kind of interesting. If you understand the hydrologic cycle, you understand why that's a thing. So how many people woke up this morning thinking you'd learn that the water you drink was also the same water that the dinosaurs drank? Okay, anyway, that doesn't have a ton to do with real estate, but I think it's an interesting factoid nonetheless. So the market. Let's cover some of our regular sort of short-term trends before we pivot into our regular monthly trends, looking at seller activity, buyer activity, so on and so forth. Let me just make sure. Okay, there we go. I want to make sure I've got the chat. I got my chat and Q&A pulled up here. Okay. So let's see. This is one of our usual suspects. So I think, most of you guys are going to be familiar with this one. This very simply looks at daily showing activity. And it simply tracks showing activity for 2019, 2020, and 2021. So you guys can see these different trend lines here. You can see 2020 in the dark gray. You can really see how COVID impacted that year. And then 2021 here in blue, you can see we've really sort of counterbalanced that dip with a nice surge. Here's where things get interesting. Notice how this year, was outperforming both 2019 and 2020, right, for the first half of the year. We know what happened in the second half of last year. So basically, starting in June, July, 2020 activity was the highest compared, well above 2019 and 2021. What's happened since? This is interesting. So all that activity, right, that was sort of sucked into, earlier into 2020, sort of slowed down a little bit, but then it was still strong at the beginning of this year, as we can see in 2021. So now perhaps we're seeing some growth in showing activity. It's not because we've had a surge this year, right? This has been on a stable seasonal decline, actually, right? Showings are up and peak in spring and then kind of decline into fall and winter. It's not that we've had a surge this year, it's that we had a little bit of a decline last year. And so again, 2020 was above 2021, and then 2020 is now below 2021. So a couple things just to watch for there. Of course, we have to brain things. Yes, nice. We have to break things out and brain things down, I guess, by price point. So what we're still doing this 2-year change from 2019 to 2021. You guys can see the showing activity from under 200K all the way up to $1 million plus. $1 million plus, 1.15 to about 2% of all showings over 2 years. Pretty significant. Another significant change, unfortunately, is in the most affordable end of the spectrum, where listings under 200K commanded 32.33% of all showings. This year, barely 19%, right? So definitely a change there. We see some growth as well as you get into the move-up market, right? So call this, entry-level first-time buyer market. Maybe call these the move-up markets, and then call these some of the luxury markets. Okay, so no surprise. Where do we see the most growth? Luxury, but a little bit in move-up, right? We see the biggest declines, of course, in entry level, in that first-time home buyer, that affordable segment. We see some solid gains still in these mid-market tiers, the move-up market. And then we see the most significant, the most dramatic gains in our luxury sectors. So sure enough, change in showing activity, right, was the most between 800K and $1 million. A note to remember, right, it's not just that there aren't many homes listed under 200 or under 250, but it's also that any home that might be worth 240 a year or two ago is probably worth 260, 270 today. So it's not just that they're not being listed, it's that those that are listed are also aging out of that cohort, right, out of that bracket. Okay. Change in new listings. Biggest decline, 150 to 200. Second biggest decline, oddly enough, over $1 million. Biggest gainer in seller activity was $500,000 up to $750,000. And don't think those people are all that crazy, because I think they're meeting the demand that's there. Speaking of the demand that's there, this is why we do this, you guys. This is why we love this. What was the biggest gain in showings? Let's go back. Biggest gainer in showings, 800 up to $1 million. That's always a leading indicator. What's the biggest gainer in pendings? 750 to $1 million, right? Which contains the 800K to $1 million price range. It is wholly contained within this $750,000 up to $1 million segment. So that's why we track showings data, right? It's a great early leading indicator of sales activity, right? That is why showing activity matters. Really quickly, I'll just plot these together. So this is from October of this year compared to October of 19, and we're looking at the change in new listings, so change in seller activity, also the change in signed contracts, so change in buyer activity. What I see is that the increase in sales are significantly higher than the increase in new supply in every price point over 250, right? Growth in blue is higher than the growth in gray, meaning growth in sales stronger than the growth in new listing activity. Speaking of new listing activity, wow, lots of decent segues here. I'm surprised. That's going better than I thought. New listing activity, what we've done here is we've smoothed things out. We've smoothed them out quite a bit. So we're looking at 2018, 19, 20, and 2021 this year. The big takeaway here is simply this, right? So check out 2020. Look at how silly, but look at how we flattened the curve, right? I don't think we flattened the curve in a pandemic sense as much as we should have and could have, but we did flatten the new listing curve, right? So look at how much new listing activity was flattened in spring heading into summer. And really it was sort of skewed out toward fall, right? So we were kind of below the prior 3 years here, and then we were above the other three comparable years here. So 2021, right, was ahead of 2020 for a long time. And then it's kind of below 2020, but that's not because of anything that's really happened in 2021. In fact, the 2021 trend line is pretty stable, pretty steady, pretty consistent with the prior years. Actually, it's above 2018 and 19, but below 2021. So here again, you guys, it looks like new listings were stronger this year, not because of this year, but because of what last year was doing. And now it looks like seller activity is a little bit weaker, not because of this year, but again, because of what last year was doing. Okay, pending sales. Ah, yes, this one's fascinating. I think these are all fascinating, but this one in particular. So here again, 2020, we saw sales activity flattened out in the first half of the year, but boy, oh boy, was that all made up and then some in the back half of the year, in the second half of the year. So that is interesting. And again, right, look at 2021, well above 2020. And then we kind of took this normal curve down, but 2020 didn't take the same curve. 2020 hit its peak in August or September, right? Most of the time we hit our peak in May and June. So we can see that things were just leaning or skewing toward the back half of the year. That's sort of screwing up a lot of our year over year comparisons. So that's why we see some percent change figures. Some of those figures look pretty extreme. Yeah, the ratio, yeah, it's a little interesting. I think we're going to skip that for now, just in the interest of time. When it comes to data analysis, you excel. All right, HAI, Housing Affordability Index, all joking aside. This is metro-wide going back to 03. I know this is a little bit of a complicated one to understand, but just simply simply think about it this way. Higher numbers are better affordability, right? Lower numbers are worse affordability. And then just think about it this way. An index of 120 means the median income is 120% of or 20% higher than the minimum income needed to qualify for the median priced homes under the current interest rates. I know that's complex. We acknowledge that. We own up to that. And that's why, that's why it's an index. That's why higher numbers mean greater affordability. Lower numbers, of course, correlating with worse affordability, lower affordability. You guys can see when at the peak of the Great Recession in the Valley of home prices, homes were pretty affordable, right? Over 200 on our affordability index. Well, no kidding, right? Rates were pretty friendly. Prices just went on sale significantly. And so affordability was pretty good. As prices have risen, affordability has deteriorated a little bit. However, this shocks some folks. And to be honest, I was surprised by it as well. Most would not suspect that we've actually had rising affordability technically. Why? Yes, prices are rising, right? That's on the harming affordability side. What's on the helping affordability side? Rates and incomes, right? Both of which have supported affordability, right? Rising incomes and falling rates. That's why we have actually an increase in affordability, which many of you are thinking is probably pretty insane, but it's the fact. Life is filled with surprises, my friends. Okay, so let's do a little bit of a forecast. Let's say 340K and 3.5%, right? Which I think 340K, well, I don't think we'll hit 340 this year. I think we'll probably be more like 3.25, 330. We did have some months at 350, so maybe we're 337, 338. Hard to say, but we're not at 3.5. We're at 3.1%. But let's say we are at 3.5 and we're at 340. That would bring affordability down to 128. How about this one? Maybe in a couple of years, we're 360K for a median price, and we find ourselves at 4%. Well, that would get us to an affordability index of 117. So that's pretty low, right? That's kind of pretty close to 2005 levels of affordability in 07, but it is still above 05, 06, and 07. But it is getting there. So just be aware, as prices and rates change, affordability is going to change as well. Okay, housing market activity. This is the ratio. This is why I skipped the ratio, because I knew we had this longer term view. Ratio of sales to new listings. So really simply the ratio of demand to supply. 84.5%, right? This tells us sales, the ratio of sales. For every 100 sales, there's about 84.5 closings. Now this is annualized. There are actually some months where where this ratio is greater, and we see that on the weekly basis in particular, where we actually see this over 100%. All the way back to 1967. Again, how many of you woke up thinking you'd see data going back to 1967? I would argue very few of you. Okay, so you can kind of see this has come in waves and cycles a little bit here in the late 70s. Really strong demand relative to supply. We had a little bit of a recession when rates spiked in the early 80s, late 70s, early 80s. You can see sales relative to listings actually fell. Here's our tech bubble, dot-com bubble heading into 2001. We can see housing was strong then. Housing demand was pretty overwhelming relative to housing supply. Heading into our Great Recession and foreclosure crisis and mortgage crisis, right? Demand sank relative to supply. Here we are, supply is weak, but demand is really strong. And we've posted a brand new, fresh record high, right? 84.5% as a ratio. Highest level we've seen of any year going back to 1967. Pretty remarkable. I've just smoothed that out, just kind of looking at that trend a little bit smoother. Not much to say there. Okay, so here we go. Here are our usual suspects, our typical major indicators, major metrics, seller activity, buyer activity, prices, inventory, market times, and so on. So here we are looking at October new listings. What do you guys see? I see that listings used to be higher than they are now. Wow, go figure. I also see that last October, we had a noticeable jump in new listings, right? Compared to October of 19. What we find this year is, for every step we stepped up, we've kind of stepped back down. So 6288, 6196, so 6300, about 6200. So we have come down. This wasn't sustainable. Part of that was still, we were in the great shuffle where people were thinking about, do I need a little bit more space with single family? What's happening? Millennials are making babies, believe it or not, looking for more space and stuff, but I wouldn't know anything about that. So we do see new listings, have come back down, sort of matching those 2019 levels. We are obviously looking for more seller activity. We're not seeing it yet. However, it is encouraging to see we're at least off of these lows. But again, everyone on this call here knows a buyer who is thirsty for additional options, for additional choice. Pending sales, similar story, but with important differences. So on the sales side, on the pending side, I should say, we saw an even more robust gain, right? 25% surge, right? 24.5% surge in signed contracts. Really kind of a pie in the sky, and by far the highest number of pendings for any October of any year going back to 03, right? We can really see that kind of sticking out like a sore thumb in the data. And then, right, we had to kind of normalize. So we were up 25% roughly. We were down 10%. This was not sustainable given where our inventory is at, just where we find ourselves. So we had to kind of normalize a little bit. Here's what's encouraging and here's what's important. This was an anomaly, right? This was part of the feeding frenzy of last year. However, as we see some of those heightened months, feeding frenzy months sort of subside a little bit, there's still a lot of demand in the market and very tight supply. So again, we've seen that come down. However, we are above 2019 levels, and I think that's pretty important. Because 2020 isn't really a comparable year because of what happened and because of all the insanity and sort of extreme market conditions that year, 2019 is probably a better, more comparable year, right? So we're up, what is that, 600? So what is that, a little over 10%? I don't know, 11, 12% over 2 years. So what is that, 5, 6% on average per year? It's not that bad. So just be thinking about that. Similar story with closings. This is the trend, you guys. This is not the trend, right? This is the trend. This is an outlier. This is an anomaly. This is the trend. And you guys will notice we've gotten back on trend. So here again, down from 2020, of course, right? Like basically everything, but still up from 2019 and actually up a decent amount from 2019. So we are seeing, solid, stable growth overall in terms of the long-term trend, even though, yes, sometimes WCCO, KARE 11, NPR, Fox 9, CNN, whoever, CBS, whatever, sometimes they like to latch onto this figure and they like to say, oh my God, sales fell 16%. The market's crashing, right? Well, not really. Technically, yes, sales were down 16%. But the second part of your statement is empirically false, right? So, sometimes we just have to ignore the anomaly or the outlier, even though it was a real thing that happened, and we can kind of get back to our overarching trend. Okay, market times. We've been dorking out a little bit too much, you guys, so I'm going to speed up a little. Market times, dead even at 14. So 2 weeks on the market, on the median, telling us what? Half of the signed contracts went under contract in more than 14 days. The other half of our signed contracts went, I should say, of our accepted offers went under contract in under or fewer than 14 days. A far cry from the 110 days back in October of 08. Oh, the good old days. Median sales price last month, how did we do? Up about 8% to 340K. 8% is still a pretty decent rate of growth, but it is down from the 12.5% growth that we saw last October during the feeding frenzy. And you guys can see acceleration here, 4.5, 7, 6, 8.5, 6, 12.5, 8. You know, was everybody's income rising at 12.5% per year? Probably not. So obviously that caused some concerns. You know, we have sustained that growth, but we haven't sustained that growth rate. So prices haven't come down, but they're not increasing at quite the same rate. Okay, what else we got? Pardon me, guys. Median sales price. So there's our 7.9%. It's right there. Excuse me. Okay, better. And we're back. I got my booster shot, I promise. I do not have COVID. Okay, median sales price, October. There's our 8% growth. I want you guys to notice that is about half the growth rate that we saw in May of this year. So from 16.5% down to about 8%, you know, still growing, but at a lesser rate. When people hear, you know, that price growth has slowed, the part they miss is growth. The growth has slowed. It's still growth. Prices are still rising at 8%. Pretty decent clip. They are not rising at the 16.5% rate that they were, you know, back in May, 5-6 months ago here. Visualizing that a different way. We are all about data viz here, visualizing our MLS data in different ways to help you guys understand the market, help you grow your business, understand risk, help your buyers and sellers. So there you have it, guys. There's your 8% down from your 16.5%. And we can really see ever since the beginning of, ever since the middle, second quarter of 2020, right? Kind of April, May, June, we saw price growth accelerate. We saw roughly 10% plus price growth really consistently since you know, May, June of last year. And you guys can see that is up from where it had been. Percent of original. This is simply the ratio of sold price to list price. Last October, sellers were sitting pretty, 100.5% of their list price. This October, they're still sitting pretty, but 100.3% of their original list price instead of 100.5%. Still over 100, but 0.2 less than last October. June. How are we doing in June? 104.25. Just thought I'd show that to you guys. So, you know, 104.25 for June, but for October, you know, obviously a little bit different. You can still see something happened here, right? Clearly, and we know what that was. Inventory. We don't need to discuss inventory because there's plenty of it, right? We can move on. I keep recycling my old jokes with you guys. I got to find some fresh material. So inventory used to have 34,500 listings under active status in the North Star system. Last month, 7,700. 7,700. That was down 16%, which is somewhat encouraging because it's not down 26%. But safe to say we need more of this, right? I'm sort of ever amazed by the fact that, you know, over 14 years, housing supply has cratered 77%, while population growth has only increased. And while, you know, we have one of the highest home ownership rates in the nation, but it's kind of been up and down, you know, since the Great Recession, but we are, you know, one of the highest in the nation. Who do we flip-flop with? Is it Vermont? Believe it or not, I think West Virginia is up there because incomes in the coal mines are decent, but homes, you know, you can get a home for 60, 80 grand. And some of the coal jobs that pay 60 or 80 grand. And so, you know, affordability and home ownership is actually pretty good. In a place like West Virginia, probably not, maybe not the place that comes to mind, but there you go. Again, life is filled with surprises. Of course, this transfers into month supply, right? Transfers pretty nicely and pretty cleanly. So you guys will notice we had almost 10 months of supply, right? 9.5 months of supply. This is a buyer's market back in 07, 08. Here we are with 1.7 down to 1.4 months of supply. This is undoubtedly one of the strongest sellers markets we've seen in 20 plus years. I hesitate to say ever because our data only goes back to 03, but I'm pretty confident saying this is probably the strongest sellers market. You know, I'd probably go beyond 20 years. I'd be pretty comfortable saying 25, maybe 30 years. I can't speak to the 40s, 50s, 60s, and 70s, but a historically strong sellers market. I can say that with confidence. So we always like to think through some of this stuff. This is going to be familiar to some of you, so I'll kind of blow through it a bit. But others who are less comfortable with the content, or who just feel that month supply of inventory, which is the same thing as an absorption rate, has always felt elusive or a little bit academic, you know, kind of an academic intellectual exercise. It isn't. It's a practical, it's a really practical metric. So let me just take 20 seconds here. Sellers markets, how do we think about them? A lot of buyers, they're all excited, but there's only one home to buy. This is a seller's market because this seller has all the power, right? They've got the leverage, they've got the negotiating power. They're not going to do anything on your inspection list. They don't have to, right? They don't have to, because they've probably got full. If this guy wants them to do the roof and the boiler and the floor sanding and the something else and the siding, you know, the vinyl siding fix, one of these other four offers is going to be in all cash and probably 100, if not 102%, right? So that guy, that gal is not going to have a lot of luck in this kind of environment. Now, contrast that with the buyer's market, where actually there's a lot of sellers on the market, but they're competing with one another to lure in this limited pool of buyers, right? So here, buyer's market, these buyers have control. They've got all the power now. Right, so in sellers markets, low supply, high demand, sellers at an advantage, homes sell quickly, prices rise quickly. Opposite with the buyer's market. This is high supply, low demand. The buyer has the advantage, homes spend longer on the market, and you might see slower price growth or even price declines. Is this such a radical request? Are we radical people? Is this crazy to ask for a balanced market with between 5 to 6 or 4 to 7 months of supply where neither side has a clear advantage, and most of our growth in our major metrics is sort of in line with historical averages? Is it so crazy to ask for that? I guess it is, because we can't get it. Okay, this is a pretty nerdy one, so I'm going to speed through this one too. Just know that there are sort of 4 categories here. These are undersupplied markets with falling prices. These are undersupplied markets with rising prices. These are oversupplied markets with falling prices, and these are oversupplied markets with rising prices. Couple things to notice. The most common clustering is markets that are undersupplied where prices are rising. We see all the concentration there. However, and by the way, this is over the last 10 years for the top 20 Case-Shiller markets. So, the other sort of concentration, looser, more dispersed or diffused, but still, a clustering compared to the other quadrants, is of course markets that are oversupplied where prices are falling. So these are markets with over 6 months of supply, but where prices are actually negative here instead of growing. I don't want you guys to feel confused by this. I know this is kind of dorky. Here's what I want you to take away. There's not a single market with under 6 months of supply, I should say fewer than 6 months of supply, where prices are also falling. That is remarkably encouraging to me, right? That's remarkably encouraging to me because it says until we hit 6 months of supply, we're pretty unlikely to see softening prices, right? Prices are pretty unlikely to fall so long as we're undersupplied, as noted by under 6 months of supply. So do with that what you will as you're counseling your buyers and sellers. A little bit of price reduction analysis. This takes a little bit of legwork to get to, but I know it's important. Some of you may be surprised to learn that 50% roughly of our deals had a price reduction between 2009 and 2012. Last year, about a quarter, right? Just over 25%. August alone, taking a look at just August, so similar 50%, but then down to 17.2, right? Remember what was last year as a whole, about 25. This August was 17.2. Forgive me. This stuff wanted to crash Excel. In fact, it was successful at crashing my Excel. And I've got a pretty nice computer. And so I tried to rescue this chart before it crashed and didn't save. And so I rescued it. But that's why it's sort of grayed out, because Excel was mad at me. The Excel overlords are striking back. So for October, right, we still see those 50%ers, a little bit higher because this is a fall. Well, sometimes it's a winter month, right? Don't start the Halloween blizzard. I know. So check this out, though. For October, we actually did register a little bit of an uptick in price reductions, right? Just a little bit of an uptick. So October of last year, here again, you guys. So let's zoom out a little bit. When in doubt, zoom out. I think that's actually a slide. Look at the trend. This was an anomaly, right? This is an outlier. So sure, it's ticking up a bit, but look at the trend before. If this trend were intact, you'd expect what? Down to 30, maybe 29. Let's be generous and say 27 or 28. It's actually as low as 23. That is up, but that's still well below, what this trend would sort of suggest. So a couple interesting insights there. Monthly, this is where the magic happens, you guys. So monthly, all the way back to the beginning of 2019 and all the way through last month, through October of this year. Wow, who knew price reductions were a seasonal thing? Who knew, right? When all the demand is in the market in April, May, and June, it turns out listing agents don't have to make a lot of price reductions, right? They just don't have to. The demand is there. Now, if you got a motivated seller and they're really looking at unloading their property during winter, you got more like a 40% chance of a price reduction. But that's really just for, December and January. I suppose for November, it's 36%, October, 31 to 32. So we see this normal seasonal curve. Now, that was 2019, 2020. We see sort of a seasonal curve. We also see a W, right? This is a U. This is a W. This is once again a U. What's with the W, right? Bizarre, totally bizarre. The prevalence of price reductions actually declined from July into August, August into September, right? Look at September. This is September. In September, usually we've had 1, 2, 3, sometimes it's our fourth month of rising share of price reduction, right? Let's see September here, this year, right? So 1, 2, 3, 4. It was our fourth month. Look at September of 2020. We had actually 1, 2, 3 declines heading into September instead of 1, 2, 3, 4 increases and 1, 2, 3 increases. 4 increases heading into September. Last year was an outlier. God, that's cool. I love that stuff. Amazing. Cash deals. What is the prevalence of cash in our marketplace? Another just fascinating one. There's so many storylines here, right? So many different narratives. One narrative, I guess I'd say the most obvious one, is that there wasn't that much cash used during the housing bubble, but once the crash hit, cash was between 1 in 5 and 1 in 4 sales. That's a lot, right? That's a lot, 23%. Prices were at a valley then. You saw flippers, you saw investors, you saw first-time, well-capitalized first-time home buyers, or maybe move up, kind of descending on the market. Some flips, some Airbnbers, whatever. Well, Airbnb wasn't as much of a thing back then. So you saw that decline as prices have risen in 2020 with all that demand in the market, especially younger buyers making their first or second move. Not as much of a prevalence of cash. You know what though? The cash that was in the market, I can tell you those buyers were probably more successful and less frustrated than FHA or conventional buyers. A little bit of an uptick this year. Careful here, guys. This is year to date for 2021. So every other year is complete. 2021 is just year to date. So I guess we've got 2 more months of data. I don't expect it to change a lot, but I do expect it to change. We got a couple other slides to cover, so I'll keep moving. But maybe after the crash, the reason cash has stayed more prevalent, even though prices here are well above prices here, right, by $100,000, right? What, 238 versus 330, 340, right? Even 350 some months this summer. So maybe are we seeing residential real estate, not just we humans, investors, but also hedge funds, Blackstone, right? Is it Blackstone, BlackRock? I can never remember. I think Blackstone, whatever, Goldman, right? A lot of these hedge funds, they're buying up properties and they're using them as an investment vehicle, right? It's a cash flowing investment vehicle. It's also an appreciating asset. It also has tax advantages, right? I'm not a financial planner, but you've got optimizations in terms of capital gains versus, returns and deductible things. So I think residential real estate has just become a more attractive investment class, right? Investment vehicle, asset class, I guess you could say. Man, oh man, commercial real estate not doing so hot this year or last, but residential, as we all know, absolutely on fire. Absolutely on fire. Okay, a lot of other interesting things to kind of think about. And you know what, guys? Those that can pay, I think there's more the hollowing out of the middle class. I'll go ahead and say it, right? So those kind of on the high end of that income spectrum, right? There's never kind of been more of them. And those folks have cash. Folks kind of on the lower end of the income spectrum, some even struggling to get qualified. A lot of them, if they worked in retail, leisure, hospitality, a lot of them have had a job loss. Some stimulus helps a little bit, but rents are rising and costs are rising and inflation's running pretty high. So a lot of different concerns there. Just one way to think about it. Just one interpretation. Okay, million plus, 51% spike from August of last year to August of this year, up 51%, 166 in just 1 month, right? We had 60 in 2006. We have over 160 now, right? That's August. How about October? This is interesting. This is important. Has this trend peaked? Has luxury demand peaked? I don't know. 103% is ridiculous for million plus, right? You just don't see that, right? Doubling from last year, from 70 to 140, a clean doubling, right? Down 10, 12%, still ridiculously high compared to every other October for every other year back to 2003, still ridiculously high, but down 12%. Year to date for October, we're still up 26%, right? So sometimes it's interesting to kind of tease out, 1 month and versus looking at the year to date numbers, and a couple different interesting insights there. So luxury still going strong. Those folks are doing well. In fact, they've never saved so much. They're not going out to eat, and they're not going out to drink. They're not going to sporting events. They're not driving as much. Those folks are able to work from home. So there's a lot of benefit. And that is showing up in their willingness to unleash their assets and savings and capital into residential real estate. Spoon and Cherry, did they really take the Cherry down? I haven't driven by there in a little bit. I hear they took the Cherry down for, is it once every 10 years to put a fresh coat of clear coat on it? Something like that. Anyway. So, folks, some of you are aware, I really hope at least some of you are aware, we just released a white paper just the other week. And the white paper was a follow-up. It was part two. It was a follow-up from our part one of are people really leaving Minneapolis? Are people fleeing the city? Is there an exodus, as some in the media have claimed, have asserted? The answer that we found, maybe some of you will be surprised, maybe some won't. The answer we found is no. People are not. There's not an exodus out of Minneapolis. However, there is a higher rate of turnover in the city, meaning new listings are up, but sales are also up. So yes, there are more sellers, but there are also more buyers. One way to look at that, and this isn't just Minneapolis, this is Minneapolis and St. Paul. What percentage of our metro-wide sales are taking place in our core cities, in urban areas, true urban areas? Check out our condo bubble, 2009, 2010, right? We had a lot of sales happening downtown. A lot were condos. Bubble kind of burst. We saw the new construction leave downtown and head out to the suburbs, to the Lakevilles and Blaines and Woodburys, as those guys were kind of built out. What do we see happening? So here's April, right? You know what, guys? Let me zoom in just a little bit. This will help us just a tad. All right, let me zoom in a bit. So here's April of last year. Enter COVID, and we can see, urban market share fell. However, beginning late last year, it kind of began to surge again, and it actually got back above where it was pre-pandemic. Again, I think people would be surprised by that. So that's an interesting data point. And not only has it risen significantly, it's gotten back to its highest level. I should say it is currently at its highest level since September of 2015. That's a 6-year high for the share of our regional sales happening in our core cities. 6-year high. That doesn't quite jive with everybody leaving the city. Okay, let's look at this. Looking at this alone, it is concerning. This was a concern. Look at new listings, Minneapolis in blue, suburbs in orange. Look at the surge of seller activity in the city, right? We see 30% gains in seller activity at a time when the suburbs actually had a decrease. One caveat here, you guys, this is a 12-month moving average. The raw data you can kind of see is behind. You can also see that raw data is pretty volatile. It's pretty noisy. That's why we've kind of smoothed it out. You can see here in blue, right? You can see where it's at. Some months were actually 50%. So overall, you guys can kind of see how that looks. One other way to look at that, I want to just make a comment on short-term versus long-term trends and patterns versus anomalies. We already kind of talked about that as we talked about new listings and pendings and closings region-wide. But in Minneapolis in particular, take a look at this. We've plotted two things. Blue, actual new listings in Minneapolis, along with the percent change. In red, it's the same number of new listings for these 4 years, but it's spread out evenly. And if you spread it out evenly, you're at about 4% growth per year. Nothing concerning, nothing out of the ordinary. In fact, maybe weaker than some buyers would like to see, who are eager to get into ownership. So, down 10%, up 46, down 20%, overall, that's sort of smoothed out to 4% growth per year. So, is this the trend, right? Is that now the trend? No, that's not the trend, right? This is the trend. This is an anomaly. This is the overall trend. These are kind of outlier points. So, yes, this happened. It's real. We're not saying it's not real. But, when you see this 40% increase, oh my God, it's going to be 30, 40, 50% increases from here on out, right? It's just not the case. It's just not the case. Another way to think about that, just check out this this home price index to median income. So this is price to income ratio. Cycles, right? Kind of high and low and really high during the bubble, and then really low after the crash into 2011, 2012, and now sort of accelerating again. Guys, anomaly, right? This is not the pattern. This is not the trend, right? This is an anomaly. This is the trend, right? This is the pattern. These are anomalies. They're real. They happened. They were recorded. But to say that, this is now the trend, obviously that's not factual. Okay, let's shift over to the demand side. This is important. Look at the demand in the city. Demand in Minneapolis surged 30% plus. Again, look at the background. We see 40% plus increases in sales activity, right? So if we didn't see these corresponding gains in demand that met up with those gains in supply, the increases in seller activity, I would be slightly concerned, right? I would be. But, this is a sign of strength that sure, there are some sellers, who are looking for more space, who are concerned about health, who don't need to be so close to work because they're remote now, who don't appreciate the fact that, bars aren't in restaurants and First Ave isn't back to what it used to be, and that they can't go see a Vikes or a Twinnies game, right? I'm sure some people, I'm sure there were concerns about the unrest as well. I'm sure that was a factor for some. Whether it's a majority, a factor for the majority, this is where we can't really make commentary about that because we just don't collect data on it. But anecdotally, we still hear for every person selling in Minneapolis, there are at least 1, 2, sometimes 3 or 4 or more looking to get in. So, this confirms that. Days on market, we still see, market times mostly shrinking in the city. Lately, we have had some increases, and we see the suburbs still shrinking. So homes in the suburbs still selling more quickly. Although here again, look at orange. We do see orange. Orange is actually right here. So it looks like market times could be getting ready to increase in the suburbs, even though they've already started to increase in the cities. So let's back up again. Aside from age, size, and style of homes, not people, right? Is the Minneapolis market truly all that different than elsewhere, or is it just first? Do trends and changes just happen first in Minneapolis before they trickle out to other areas? Historically, right, it's actually urban and luxury markets that are the first to show these signs of change. Look at condos downtown, right? That was kind of the first whiff of trouble back in 05, 06, before it again trickled out into sort of the rest of the world. A couple more interesting insights here. Let's do a time check. 10, 12 minutes. Okay, let's keep moving here. Change in square footage. Look at this. This is fascinating. Buyers were buying larger homes in the city, right, in Minneapolis. So square footage of homes in Minneapolis actually were increasing by 4%. In the suburbs, only about 1%, 2%. And now, even lower still. Not a surprise because homes in the city are smaller. So, you have to push square footage a little bit higher if you're going to get more space. So not a surprise, but still an interesting data point. Median total square footage. Minneapolis in blue, right? Smaller, but cozier and more charming homes, right? Versus the suburbs, 1,900 or about 2,000 square feet. We talked about the condo bubble downtown. Check it out. Take a look. 06 sizes, condos heavily influencing sizes, right? Condos tend to be smaller. And so we saw sizes reflect that in Minneapolis. Pretty interesting. Change in price. Minneapolis in blue, suburbs in orange. We do see price growth in both areas. However, price growth has tended to be a little bit stronger in the suburbs than in the city. We do see price growth slowing down toward 0 in the city. It looks like that trend might be beginning in the suburbs, as we can kind of see. Guys, I'm reading maybe a little bit too deeply into the tea leaves. Just know, as we see some of these changes in the city, it's quite possible we see some of those changes, trickle out, a little bit further out. Let me back up again, right? We are not forecasting any kind of housing crash. I want to reiterate that. However, we could see a few months of prices moving sideways or even down a little bit. That does not mean that we are due for a 2008, 2009 all over again, where prices cratered 20 to 35%, right? I can't make a lot of guarantees when it comes to the market, interest rates, the economy, but I can pretty much guarantee you that we just won't see that, right? We just won't. Percent of original list price. These were matching up with one another pretty nicely, right? Growth in the suburbs and growth in the city. Looks like this metric has softened a little bit in the city, and it actually is negative. So our trend is turning down, but the raw monthly data has actually gone negative. And it looks like here again, you guys, I know we're kind of getting a little dorky, but so look at blue, that's Minneapolis, but here, look at orange, that's the suburbs. Suburbs already at zero. I would be surprised if we didn't see some minus signs there as well. So is the city different, or is the city just first? Maybe a little bit of both, hard to say, but maybe more first. Change in inventory. So here we do see a pretty important difference. We have seen inventory growth in the city that we just haven't really quite seen in the suburbs. Look at this though. The year-over-year declines in suburban inventory, went from down 50% to now only down what, 10, 12%? I'd say we're likely to see some growth here as well, which is exactly what buyers want, which is exactly what people want. Month supply, very similar trend. I won't go too in depth into that. I already made this joke. My colleague Ross actually said this first. I don't know if he invented it, but he was the first that I heard say it. When in doubt, zoom out. All right, let's take a look at rates. Most recent data, rates 3.1%. If you want to know what's going to happen with the 30-year fixed rate tomorrow, take a look at the 10-year treasury today, right? Or actually take a look at the 10-year treasury yesterday or from Monday or something. So take a peek. 06, what were rates at? 6.75%. The last time prices were even close to this high, right? Peak of the bubble. We were financing these purchases at 6.7, 6.8%. Here we are, just barely over 3%, right? At one point, we were 2.65%, all-time low. And we're at 3% now. So what does that mean? Why is that important? Couple reasons. Home prices in blue, peak in 05, down into the crash in 2010, 11, and 12, and then the recovery that we've seen so far. Prices are above their previous peak. Let's skip over to interest rates. Oops, I'm sorry, guys. Interest rates, let's skip over. Light blue, rates. Down, 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 right? So prices are at all-time highs, but rates are pretty much at all-time lows, which means what? It's offset the monthly housing costs. It's offset that monthly PITI payment, the principal, interest, taxes, and insurance. So look at green in the middle. Right. So yeah, payments hit their peak in 05, and then they kind of hit a valley when everything went on sale, and they have been climbing, right? Payments have been climbing. But the typical payment on the median priced home under today's rates is actually below where it was in 05. Careful here. This is not adjusted for inflation. We are working on getting some inflation adjusted charts sort of resurrected. We actually had them a while ago, so we still have them in our templates. But we have to kind of update them a little bit. So that's coming. Inflation has been running high. We could do a whole nother 2-hour webinar on it. I won't. I guess I'm in the camp that I do believe it's more transitory than people think. I don't think the CPI will decline. I think we'll keep these gains. But I think, as we get into later next year, I do think I expect to see +2%, +3% instead of +5 or 6%. Gentleman's bet, right? I wouldn't put money on it. I'm not a betting guy, but we're in a situation where we just have so much demand chasing so few goods. And I think that will work itself out a little bit. So, okay, enough of that. Number of offers per listing still well above average. It used to be almost 5. Actually looks like just about 5 offers per listing. We are all the way down to 3.8 or 4. That was August. Maybe we're down to probably closer to 3.5 now, but going all the way back to 2017, right? 2.5 offers, I guess 3 offers. So, COVID surged, helped us surge to 5 offers. And then we've kind of slowed down to maybe 3.5 offers per listing. Guys, what was it? 2 months ago, the heading of our press release was, the market has slowed from Mach 3 to Mach 1. But I'll say that again. The housing market has slowed from Mach 3 to Mach 1, right? This is Mach 3. This is Mach 1. And maybe this is Mach 2, right? Maybe this is more like Mach 1. So Mach 3, Mach 2, Mach 1, and maybe this is just regular, 500 mile. This is a regular plane. These are super jet, super fighters. I don't know. I don't know what analogy I'm after there, but anyway, we've come down. We've come down from Mach 3 down to Mach 2 or Mach 1. Still fast, but slightly slower than last year. Okay, let's see. We're coming up on time here, guys. Forbearance, we're tracking this. It's getting better. We are not expecting any kind of, surge or dramatic increase in foreclosure product. Maybe we see a little bit. The demand is out there to absorb it, especially if it's bargain priced, 60, 70, 80, 90 cents on the dollar compared to traditional. I think that'll be a good thing. I want to quote Ivy Zellman of Zellman and Associates, right? So the likelihood of us having a foreclosure crisis again is just about 0%. Purchasing power. What happens as rates go from 3% to 3.25% to 3.5%, all the way up to 4%? So here's your payment on a $300,000 loan at 2.75%. If we want to keep that payment the same, right? Or within $5-10, per year. If we want to keep that payment the same as rates rise, look at what happens to our purchasing power. It erodes a little bit. So if I like that 12.25 payment, or roughly, 12.25, 12.50 payment, it's a $300,000 loan at 2.75. So maybe that's a $325,000 home if I can do 25 down, or $330 if I can do 10% down, $360 if I can do 20% down. So as rates rise, if I want to keep my payment stable, static, flat, my loan amount has to decrease, right? Duh, right? I know you guys know that, but sometimes it's useful to sort of visualize it, and a handy tool to use with buyers and sellers. Average equity gains over the last 12 months, Minnesota, $33,000 over a year. The typical homeowner, right, is worth $33,000 more. Some homeowners are worth $300,000 more. Well, it's a little unlikely to see $1 million home appreciate to 1.3, but so some homeowners are going to be 50, 100K. Others are going to be only 5 to 10K. Some might have lost. I'm sure some gain more. Look at our friends in California, 115. Our friends in Seattle and Washington, 100K. But we're pretty close to, I guess, Texas and New Mexico and Missouri. And surprised that Indiana beat us out. Those Hoosiers. They've got nothing on the Gophers. Mortgage rate projection. So what's going to happen? We know that we're in a rising rate environment. At least we're 98% sure we are. But what does the future hold? So mortgage rate projections, right? Fourth quarter of this year, here we are, 3.17 as the average for Fannie, Freddie, the mortgage folks, and NAR. Pretty close to where we're at. First quarter next year, they're thinking maybe 3.33. Maybe more like 3.25, maybe more like 3.25, 3.33, definitely a possibility. Second quarter next year, closer to just under 3.5. By third quarter next year, they are suspecting will be 3.5, little over 3.5. Moral of the story, I think we're very unlikely to pass 4% next year. I'd even climb out on the skinny branches and say we're probably unlikely to hit 3.75 or 3.8 next year. Maybe we touch it. Maybe we don't go beyond it. Guys, please, this is not a guarantee, right? This involves risk. And no one can predict this, or they'd be on an island in Tahiti sipping mojitos or whatever you drink in Tahiti. Tahitian treat, whatever people drink there. So rising rate environment, but not a quickly rising rate environment. And even if we are in a rising rate environment, rates will remain historically attractive for years to come. Home prices, what's going to go on? What's going to happen with prices? Well, next year they're thinking about 12%, but moving forward, more like 6, 4, and then kind of settling into 3.5, 3, 4, 5 years from now. So pretty interesting stuff. We are exactly at time. How do you guys like that? Amazing. I'm going to stop in the name of love, as I do. And we don't have a ton of time, but I want to just open it up for a quick Q&A.
Awesome.
Let's see.
I haven't seen anything come through. We can give it a second here.
Oh, huh. Okay, interesting commentary here. Thank you, Tim. Appreciate it. Anybody? Nothing? Should we
All right.
call it good, Ann?
I think so. Again, this will be on our website and emailed to you guys in the next day or so. So thanks for being here, and we will see you again next month.
Thanks, everybody. Thanks, Ann.